Good morning everyone. This is Abid Khan and you are watching Karachians Academy YouTube channel. We are doing A-level accounting paper 9706 and we have selected attempt May-June attempt 2022. Yesterday in our last videos we have done with few questions. Lastly we were doing question number 6, the last question, and we did part A and B. So today we will be doing part C. So let's move on to question 6, part C. Okay, this is part C, and what part C says, the directors decide that NPV method should be adopted because your NPV at the cost of capital of 10% was positive. So NPV method is fine. So they have adopted this. One of the directors has concerns about the total sales target, right? To achieve the total sales of 2,500 units, he has following suggestions. One of the directors is giving few suggestions. The selling price should be reduced by 1% from 28 minus 1 to $27. Fine. Advertising cost 8,000. This is advertising cost as a fixed cost. Should be incurred in both year. Only in year 1 you have to incur this 8,000 and 8,300. Year 3, the units produced and sold for each year should be same. Should be same means how much were our total units? Our total units were 25,200. So what it means? It means so average units per year 25,000 and 200 was our unit. 25,200 were total units, and how many years we have? It was 4 years. So divide this by 4 years. So how much it would be? Just 1 minute. Let me have the calculator. So 25,200 by 4, 6,300 units. We can say this is working number 1. Now, so 2 changes are he is suggesting. Number 1, he is saying to reduce the selling price, so that will reduce your contribution margin as well as net profit and as well as your net cash flows. And also he is suggesting year 1 and 2 to invest additional fixed cost of advertising 8,000. So in year 1 and 3 further there will be reduction due to this. So explain what is meant by the term sensitivity analysis. Fine. Assess the impact of the director's suggestion on the decision to buy the new machine. Support your answer with calculations. So first he is asking what is meant by the term sensitivity analysis. Actually guys, sensitivity analysis is in practical life it is referred to as scenario planning. Actually when we do business, so in business we have different scenarios. So in future we might be facing different scenarios. So we make different scenarios, like if we are selling our product and our competitors just to have more market share from the competitors, if they think they can increase their discount and reduce their selling price, so they might attract more customers. So they can offer they can make a proposal that reduce the prices by offering the special discount, or they can ask if you add few advertising cost, or if you reduce your cost, by introducing some other methods of production. So in different scenarios we work, and how much would be the profitability, and management accountant's responsibility is to provide management with those results, financial results on different scenarios. So it normally sensitivity analysis is done in all the businesses by simply changing their variables like prices and cost and all these things, and see how the financial impact would be in future if they go with this scenario. So let's see what the marking scheme is saying here. So we can look into the marking scheme. So marking scheme says, so investment appraisal is based on the assumption used to forecast sales volume, selling price and cost. This is very much right. So because sales volumes are based on certain assumption that we will be getting so much market share, and competitor is providing this much, he is offering product on this much sales price, so we can offer this much. So all the sales forecasting is done based on certain forecast. So in investment appraisal, the assumptions are subject to uncertainty and risk. So and we know, we do not, what we are considering and we are forecasting that this much will be the sales price we will be able to catch from the customers. So might be your competitors offers a better price, then you won't be able to attract more customers. So there is a risk, and this is not only the risk relating to the customers pricing, there might be other risk, business risk, right? So the scenario can change. So we make different scenarios. If this risk arise, if that risk arise, what will be the situation? So sensitivity analysis is, this is what it is. Sensitivity analysis is right. So sensitivity analysis is basically what if analysis. Actually we do analyze if what will happen if this happens, if prices reduce, if prices increase, if costs increase, if international prices get reduced, economic economy do not perform well, and inflation increases. So all these factors, what if situation is first devised, and then we do the profit planning or the financial planning based on them. So that is called the sensitivity analysis, which is basically a what if analysis, calculating the effects of changes in these assumptions, right? So this is quite clear. So move on to next question. So sensitivity analysis, you further read this now. So we are done with question D. Now question E, assess the impact. So this is again, this is the practical of sensitivity analysis, because here the director is doing the sensitivity analysis. He is making a scenario, if we reduce our prices by $1 and we invest more money on our advertisement, on media, on electronic media, on social media, so how we will be able to earn, and how we will be able to achieve our production sales volumes. So this is an scenario. So we have to do workout. We have to work out its so right. So again we can work out it this way. So what he's asking, question asks, assess the impact of the director's suggestion on the decision to buy the new machine. Support your answer with calculations. Actually management has decided to go with NPV option, right, at the 10% cost of capital, right? So now they are saying, if these what if happens, so what will there be any change in the your decision of selecting this asset based on the NPV, because your NPV is positive and you have decided to go with this machine of $160,000 and invest in 160,000 based on the NPV. Now what they are asking if the situation changes, so what will be the financial situation, financial forecasting number one. And will you be go with this machine on, and will you be go with this machine, what your financial would be there. So we have to calculate the NPV, and if the NPV is positive under this scenario planning, under this what if situation analysis, so then we will go with this. Otherwise we will say this situation and we cannot go with the NPV. So yeah, these are your years 0, 1, 2, 3 and 4, and how much was. So we can do one working here, working 2, working 2, we can do working 2. Your sales price are 27, okay, and your monthly average would be 6,300. so your sales under this situation will be, I can make it here. So your annual sales will be 6,300 units into 27, that will be 6,300 unit into 27 selling price, reduced selling price. So you will be earning 170,100, okay. This will be your sales. If and from this sales, if you deduct variable cost, your contribution margin will be 170,100 minus variable cost is rupees 10 $10. So 63 are units, 6,300 are units. 10% is variable cost. Your variable cost will be 63,000. Then you deduct 63,000 variable cost. This is sales, and the contribution margin will be total contribution. This is not per unit, this is total contribution margin, 107,100 and then 63,000. So this will be 107,100 per year. So every year you will be under this scenario, you will be earning 107,100 as your contribution. So this is your contribution margin. How much? In year 1 it is 107,100. Same in the next year, same in the next year, same is the next year. And now from this you deduct your fixed cost. So fixed cost, how much fixed cost? We know because there was 90,000 was fixed cost including depreciation. If you deduct depreciation of 40,000, this was 50,000. 50,000 was your fixed cost, right, excluding depreciation, and this was on 6,500 units. Up to 6,500 unit, your fixed cost was 50,000. Remember, in the part A and B we have done this. So our units are 6,300. Then our fixed cost, because this is within 6,500, so your fixed cost will be fixed 50,000 for in all the years. So year number 1 this will be 50,000. In year number 2 this will be 50,000. In year number 3 this will be 50,000. And year number 4 this will be 50,000. But now you are incurring additional advertising cost in year 1 and 3, which is 8,000. So here no, here you are again investing 8,000 in year 1 and 3. So your fixed cost is basically 58,000 in year 1 50,000, in year 2 58,000, in year 3 and 50,000 in year 4. Then your cash flow, net cash flow will be sale. This will be net cash flow will be contribution margin minus fixed cost, right? So contribution margin is 107,100, fixed cost is 50,000, 58,000. Okay, 50,000, keep it 50,000, because in 2 years it is 50,000, here it is 50,000, and year 2 and second. So year 2 this cash flow will be 57,100. Okay, and year 4 this will be 57,100, and in year 1 and 3 107,100 contribution minus, in year 1 and 3 this will be 58,000. So 49,100 and 49,100. Your PV factor at 10% cost of capital, this is already given to you in what it was 0.909. This is given in the question, and then 0.826, and then 0.751, and in year 4 it was 0.683. Your present value will be, and if you see, this is cash inflows, cost, contribution, or we can write it here 160,000 is not contribution. We cannot write it as contribution, but it is your, or either you can write it here anywhere 160,000. It is a fixed investment, and this is the capital outlay which is going out from the business, and its PV factor is 1. Okay, so 160,000, this is outflow from the business. Now 49,100 in year 1, this will be multiplied by this factor 0.909. This will be 44,632. This is inflow, right? Likewise 49,100 multiplied by this 49,000 multiplied by 0.751. So this will be 36,874, plus this will be added to your fine, then 57,100 in both year 2 and 3. 57,100. So 57,100 in both the years, 57,100 multiplied by 0.826. So this will be 47,000 net in present value of your 65. Here 57,100 multiplied by 57,100 multiplied by its discount factor or the present value factor 0.683. This will be 38,000. Again 38,999. So how much is your positive values? Positive values are, if we calculate all the positive inflows, 44,632 plus 47,165 plus 36,874. 36,874 plus 38,999. So this total will be 167 and 670. Okay, it means your present value of your positive inflows, cash inflows, is 167,000, while your outflow is 160,000. So your positive value is more. So net present value, NPV. So NPV will be, if you deduct this, 7,670, and which is positive. So it means, guys, we are okay with this scenario, and what the director has proposed, this is also fetching and this is also carrying net present value positive, and our decision criteria is when the net present value is positive, you can go with the project. So here we can go with this investment of 160,000, because in this change scenario, even then the project is earning a positive net present value. So this was all for question number 6. So we have done with this, and that's all for today. If you have any question, any doubt, any clarification, please write on to on the comment side of this video, and we will try to get back to you and quickly reply to your questions and your doubts and clarification, right? So that's all for now. Thank you very much, and bye for now.